Welcome to the Deep Dive.
Great to be here.
Today, we're really getting into the latest from Frontline, the big tanker company.
Yep, their Q1 2025 earnings call. We've got the transcript, the notes.
Exactly. And our mission, as always, is to pull out the most important stuff for you. We're sort of guiding you through all that data.
Helping you figure out what really matters from their performance, the market they're in, and where they see things going.
Right. Because this call covered Q1 results, sure, but also these big market dynamics, the future outlook, all happening amidst, well, a lot of global change.
Absolutely. And these tanker financials, they're not just numbers. They tie straight into energy flows, geopolitics, trade policy, all that big picture stuff.
So where should we start? The Q1 numbers.
Yeah, let's hit the highlights first. The reported profit was $33.3 million. That works out to, you said, 10 cents per share.
Okay. And the adjusted figures, sometimes that tells a clearer story.
It does. Adjusted profit came in a bit higher at $40.4 million, or 0.1 cents per share.
And how's that stack up against the previous quarter, Q4?
Well, it was actually down slightly. Adjusted profit dropped by about $4.7 million from Q4.
Any particular reason?
Yeah, primarily lower TCE earnings. That's time charter equivalent, basically the daily rate their ships earned. It went from $249 million in Q4 down to $241 million in Q1.
Oh, okay. So slightly softer daily earnings at the bottom line.
Pretty much, yeah.
Got it. Let's look at those TCE rates more closely then. What did they actually get per day in Q1 for the different ship types?
Okay, so for Q1, their biggest ships, the VLCCs, they averaged $37,200 a day.
Right.
The Suezmaxes came in at $31,200 per day.
Okay.
And the LR2s, or Aframaxes, the smaller ones, they did $22,300 per day. And remember, those are load to discharge rates.
Load to discharge, right. Now, this is where it gets interesting, I think. The Q2 bookings.
Yeah.
What are they seeing so far for this current quarter? Because those numbers looked quite different.
They really do. Q2 is looking much stronger based on what's booked already. For VLCCs, they've booked 68% of the days at a much higher rate, $56,400 per day.
Wow, okay. That's a big jump.
Huge jump. Suezmaxes, 69% booked at $44,900 per day. Yeah. Also way up.
Yeah.
And the LR2 Aframaxes, they're 66% booked at $36,100 per day. They did mention for the LR2s some voyage balances carried over from Q1 into Q2, which can affect those numbers a bit.
Still, that VLCC rate for Q2, $56,400 compared to their break-even costs?
Exactly. That's the key context. Their estimated cash break-even for a VLCC is around $29,700 a day for the next year.
So booking almost 70% of the days at nearly double that.
Yeah, it means that segment, at least based on what's booked, is set for a very, very strong Q2.
Okay.
The Suezmax break-even is about $24,300, and LR2 is $23,300. You'd certainly expect so based on these numbers.
Okay, so the forward look on rates is positive. What about the company's foundation? Balance sheet, liquidity, how are they looking there?
They described it as solid with strong liquidity. End of March, they had $605 million in cash and equivalents.
And that includes?
That's actual cash, securities they hold, minimum cash they need in the bank, and importantly, any money they haven't yet drawn down from their revolving credit line.
Okay.
Plus, a really big point, no significant jet maturities until 2030.
2030, that's quite a way off.
It gives them a lot of breathing room. And they also have no new ships on order right now, no new building commitments.
So financial flexibility seems pretty high. Let's talk about the ships themselves. What's the fleet look like?
It's a big fleet. 81 vessels in total, 41 VLCCs, 22 Suezmaxes, and 18 LR2s.
And age, that's always important in shipping.
Relatively young, actually. Average age is 6.8 years. And over half, 56%, have scrubbers fitted.
Right, for the fuel regulations. And we touched on break-evens, $29,700 for VLCCs, $24,300 Suezmax, $23,300 LR2. What's the fleet average, roughly?
Across the whole fleet, before you factor in dry dock costs, the estimate is around $25,700 per day.
Okay. And dry docking, that takes ships offline and costs money. What's the outlook there?
Yeah, it's necessary maintenance. Over the next 12 months, they estimate the cost averages out to about $6,800 per day across the fleet.
And that covers?
That includes the planned costs for 10 VLCCs, 2 Suezmaxes, and 5 LR2s that are scheduled for dry dock in that time frame.
Got it. What about just the daily running costs, OPEX? Looks like a bit of an increase in Q1.
Yeah, average OPEX was $8,300 per day in Q1. Slightly different for each class, $8,400 for VLCCs, $8,000 Suezmax, $8,200 LR2.
So why the jump from Q4?
Management explained it was mostly because Q4 had some sort of one-off rebates, things like insurance and supplies, that made Q4 look unusually low.
Oh, okay.
Plus, there was some accounting thing in Q4, revaluing a synthetic option liability and admin expenses that didn't repeat in Q1. So while the number looked higher sequentially, they felt costs are generally stable.
Okay, makes sense. So summing up the financials, stable base, good cash, no near-term debt worries, and crucially, Q2 rates booked way above costs.
Let's shift gears to the market they're operating in. It feels complicated. Yeah, complex is a good word. They mentioned all the noise out there, equity volatility, policy changes, trade talks.
But the tanker market itself?
They said it moved along in an orderly manner, with VLCCs kind of taking the lead.
Interesting phrasing. And what's driving that orderliness, or perhaps the underlying pressure?
Well, according to them, the absolute pivotal driver right now is sanctions. The whole landscape around sanctions.
How so? They seem pretty positive about it, which sounds counterintuitive.
Yeah, they describe developments as very positive for compliant tonnage. That's the key. Ships that can trade freely.
Okay, why positive for them?
Because the scope of sanctions is getting wider. More vessels, more operators are being added to lists almost daily. Enforcement is ramping up.
Right.
But the really critical thing, they stressed, is a change in behavior. Key buyers, like India and China, are apparently getting much better at identifying listed vessels and are becoming hesitant to use them.
Ah, so it's not just the government's listing ships, it's the market reacting. The receivers are self-sanctioning.
Exactly. That's what makes sanctions truly bite when the buyers themselves shy away. That effectively shrinks the pool of ships available for certain trades.
And how big is this pool of potentially exposed vessels?
It's significant. They threw out some numbers. 25% of the global VLCC fleet, 46% of Suezmaxes, and get this, 52% of the Aframax LR2 fleet are over 20 years old and have lifted oil from Iran, Russia, or Venezuela in the last year.
Wow, that's a huge chunk of the older fleet.
It is. And that whole population is really sensitive to any changes in sanctions or enforcement. That's largely the dark fleet or shadow fleet you hear about.
So the oil is still moving, maybe, but it's forced onto this specific, older, riskier fleet.
That's the dynamic. Sanctions don't necessarily stop the barrels flowing entirely, but they dictate which ships can carry them. And the conditions for those off-list dark fleet ships are apparently extremely poor. They struggle with insurance, finance, port access in the compliant world.
Which tightens up capacity in the compliant market where Frontline operates.
Precisely. It can even pull compliant ships into trades under the price cap mechanism, like Russia, just because the rates and conditions are better than competing in a crowded compliant spot market sometimes.
What about the reverse? If sanctions were lifted, say, on Iran, could that flood the market with returning ships?
That's definitely a risk they acknowledged, especially for the Suezmax and Aframax segments, where the percentage of exposed older vessels is higher. An Iran nuclear deal, for example, could bring back, say, 1.4 to 1.6 million barrels per day of Iranian exports into the compliant market.
Which would need compliant ships.
Right. But, and this was a strong point they made, they believe most ships currently in the Iranian trade have absolutely no chance of actually coming back to the compliant market.
Why not?
Charterer rules. The big oil companies, the traders. They have super strict vetting processes. Given the cargo value, the environmental risk, they just won't risk using a ship with a murky history or recent sanctioned activity. The reputational and operational risk is just too high.
Okay, that's a crucial barrier. So even if political sanctions lift, market sanctions might remain. What other geopolitical stuff did they mention?
Touched on a few things. Russia-Ukraine ceasefire talks could lead to sanctions easing or tightening. They felt tightening was maybe more likely near term, citing recent EUK list additions and talk of lowering the Russian oil price cap maybe to $50. The Iran nuclear deal is back in discussion, obviously linked to what we just talked about. Lifting sanctions is apparently Iran's red line.
Right.
Venezuela, the U.S. removed exemptions, meaning oil previously lifted compliantly by companies like Chevron now mostly has to go dark. That trade had grown quite a bit, up to maybe 800,000 barrels per day.
Okay. And the Red Sea? Any change there?
They mentioned ceasefire talks between the U.S. and the Houthis, but said it hasn't really changed their operational stance yet. Traffic lanes haven't shifted back. It's still fluid, attacks are a risk, and they're firm on not risking crews' lives.
So lots of moving parts geopolitically, but sanctions seem to be the main market shaper for now. What about basic oil supply and demand?
Yeah, they talked about the market being more normalized post-COVID. Interestingly, the EIA forecast points towards potentially moving into an oversupplied position in oil by the end of 2026.
Oversupplied. How does that affect tankers? You'd think less demand, maybe.
Counterintuitively, it can actually support tanker demand, at least initially. If there's more oil being produced than consumed, it needs to go somewhere.
Into storage.
Exactly. Inventory building, filling up tanks in China, Japan, Korea, the US. That requires ships to move the oil into storage. They mentioned global inventories are at years low, so there's room to build. This boosts tanker utilizations even without a contango market structure driving floating storage.
Okay, so oversupply could mean inventory builds, which means tanker demand. Got it. What about OPEC plus cuts?
Potential return of some voluntary cuts. They're seeing signals of increases starting maybe July. They noted the initial announcements didn't add many actual barrels yet, but the volumes from June onwards could be more real.
Anything else on the market front? Tariffs, maybe?
Briefly mentioned. A 90-day delay on some recent ones. Energy seems largely exempt, and the U.S. trade rep's proposal looks like it's softening, especially for oil. Final version expected end of May.
Impact on tankers.
They don't expect a major impact on global trading patterns. The U.S. is good, but it's still only about 17% of the global oil market.
Okay. So market drivers seem complex, but maybe leaning positive for compliant owners due to sanctions and potential inventory builds. They also talked a lot about the ships themselves, the physical fleet.
Right, the aging fleet. That's a recurring theme, and they see it as a major tailwind. Because, as they keep stressing, very few charterers in the compliant market want ships over 20 years old, and the actual trading fleet shrunk last year by about 0.5%. Plus, the order book for new ships is pretty small.
Especially compared to the number of older, potentially sanctioned ships out there.
Exactly. For VLCCs, the order book is smaller than the number of ships they think are effectively listed or sanctioned. And even for Suezmaxes and LR2s, where the order book looks a bit bigger on paper, it's dwarfed by that huge percentage of the existing fleet, 46%, 52% that's older and has sanction exposure. So they're just not worried about new ships flooding the market anytime soon. Okay, so given this market view, sanctions helping, aging fleet, inventory potential, what's Frontline's strategy to play this? They called it tried and true, basically. Keep lots of ships in the spot market.
Not locking them into long-term contracts.
Right. They want to capture the upside when daily rates are high, like those Q2 bookings we saw. Maximize exposure to the volatile but potentially very profitable spot market. And tied to that, they maintain a 100% dividend payout ratio. Earnings go back to shareholders.
How's the balance sheet supporting that? Any recent moves there?
Yeah, they just refinanced debt tied to 24 of their VLCCs. They describe their overall capital structure now as possibly the strongest it's been this millennium.
Wow. What was the driver for refinancing? Was debt coming due?
Not really. The main driver was actually getting a better interest rate. They got the margin from 2.0% down to 1.7%. Extending the loan term was just a bonus.
Makes sense. Now, there was a question in the Q&A about the stock price. Trading below net asset value, NAV. Why would that be? If the market outlook is good and the balance sheet is strong.
Yeah, management seemed a bit perplexed by that too, admitting the discount was surprising.
What reasons did they offer?
A few possibilities. Tanker stocks generally had a weak second half last year. Investors have other places to put money and maybe want more proof in the pudding before jumping back in. There might have been some forced selling from index funds. And they also mentioned unusually high short interest, potentially linked to big bank strategies not necessarily related to Frontline itself.
So with that discount, why not try to appease the market with, say, some long-term charters to lock in profits and reduce volatility? Why stick to the spot strategy?
They were pretty direct, trying to be quite disciplined. Said it's tempting to do time charters, but they have a very firm belief the market's going higher. They want to retain the upside. They clearly think the best is yet to come.
Okay. What about selling ships? Asset values are high, especially for older ones. Is that part of the plan?
They acknowledge the opportunity exists. Values are good, but they're cautious.
Why cautious?
Well, partly because some of the buyers for older tonnage are players involved in those dark trades they want to avoid.
Right.
But there's also interest from compliant players growing their fleets or for storage projects or conversions for ships with maybe 5-7 years left. Their goal seems to be maintaining their overall earning capacity, around 30,000 earning days a year. So maybe they'd sell one ship, a candidate vessel, but it's not like a major fleet reduction strategy.
Got it. One last operational point, dry docks. The schedule seemed to change from the last report.
Yeah, a bit confusing maybe. The Q4 report mentioned 2 VLCCs and 1 Suezmax for dry dock in calendar 2025. The new forecast looks 12 months ahead, from Q1 25 to Q1 26.
And that includes more ships.
Right. It includes 10 VLCCs, 2 Suezmaxes, and 5 LR2s. The difference is mainly because 2 VLCCs originally planned for 2026 got pulled forward until late 2025, and this new forecast now also includes ships scheduled for Q1 of 2026.
So it implies a busy maintenance period later this year and early next.
Yeah, they basically said expect heavy maintenance in Q1 2026, just based on when those ships were delivered and need their surveys. Normal part of the cycle.
Okay, let's try and wrap this up. We've gone through the numbers, the complex market drivers, frontline strategy. What are the big takeaways? They use that phrase, positive heading of pressure.
Yeah, I think that captures it well. It's a combination of things pushing in the same direction. First, oil supply demand points towards maybe some old school inventory building, which is good for tanker use.
Right.
Second, demand for compliant ships is rising because of sanctions widening and that crucial self-sanctioning by buyers in places like India and China.
Meaning the effective fleet isn't growing much, if at all.
Exactly. They expect the fleet to keep shrinking this year, while oil demand is still forecast to rise. And underpinning all that is the aging global fleet. That provides a natural tailwind, restricting supply.
A tailwind into 2025 and 2026. But there's still uncertainty hanging over things.
For sure. Policy changes tariffs, sanctions twists, geopolitics create more questions than answers, as they put it. Though maybe the tariff talk has softened a bit. They expect more clarity in the coming weeks, maybe driven by those political narratives.
And the big picture conflict remains. The world needs oil moved now, using the oldest fleet in decades.
While regulators are pushing hard for decarbonization, it's a real tension.
And Frontline's position in all this?
They feel they're well placed. They continue to retain material upside with their modern spot-exposed fleet, ready for that compliant market.
Any hints about the very near term, the next few months?
From the Q&A, it sounded like they see potential for a proper VLCC market developing over the next 6 months. But near-term swings, summer seasonality. That's likely going to be driven heavily by headlines around Iran talks or Russia-Ukraine ceasefire discussions. They seem to think more action or clarity on that front was weeks away, not months.
Okay. So we've really unpacked this Frontline call, dug into the tanker world. Why does this matter to you, listening in?
Well, I think it really shows how these industries, which might seem kind of technical or niche, are just so deeply connected to everything. Global energy, trade policy, geopolitics.
Yeah, understanding how sanctions actually ripple through to affect which ships can carry oil or how inventory levels drive demand. It gives you a clearer lens on the global economy, right?
Totally. You see the drivers, the potential friction points, the opportunities. It connects the dots between a financial report and the physical reality of moving essential stuff around the world.
And that tension you mentioned, needing these old ships now versus needing cleaner ships tomorrow, that's a huge challenge playing out across so many vital industries, isn't it?
It really is. It's seeing the big picture through these specific details.
All right, let's leave you with a final thought, something that came up implicitly in the discussion about older sanctioned ships. The transcript mentioned this real problem. Recycling yards often can't legally buy ships from sanctioned entities due to compliance rules.
Right. It creates a bottleneck for scrapping these vessels.
Exactly. And the risk is you end up with this growing fleet of older, maybe poorly maintained ships just sitting there. Potential float bombs, as some might call them, operating outside the normal safety systems. So here's the question for you. Given we urgently need to replace aging fleets and meet environmental goals, how can regulators like the IMO tackle this problem? How do you safely get rid of these risky ships when the current system makes it so hard for compliant recyclers to touch them? Is prioritizing safe disposal sometimes more critical than theoretical decarbonization for ships that might never trade compliantly again anyway?
That's a tough one. A real clash between regulation, safety, and environmental goals with no easy fix.
Something to chew on. Thanks for joining us for this deep dive.
Yeah. Thanks for listening. Hope you keep exploring this fascinating world.